distribution to shareholders. So what does this mean? What do we mean by distribution to shareholders? Essentially, so distributing dividends to shareholders, that is one example of a distribution to shareholders. Sidra, any other examples of how a company gives money back to shareholders? When a company issues bonus shares, is a company giving money to shareholders? It's giving stock. Is it giving money? No. When you get bonus shares, are you any richer? No. Okay. So what are other ways in which a company can give money back? Share repurchase. When a company buys back shares, essentially it is giving money to shareholders. Okay. So anyway, this is a very important topic because anybody who has shares or knows people who has shares will be concerned about dividends. So let's just get into this. Imagine that you are the CEO of a large company which is considering its dividend policy. Okay, what do you think, Farhad, what do you think dividend policy means? What do you think dividend policy means? Okay, so the amount of dividend that you might be giving out. So can you give us two extreme dividend policies? Exactly. So the two extreme policies, one policy is all the earnings we get, we pay out as dividends. What the other extreme is, generally tech companies in the US for many years while they were growing did not pay any dividend. So those are two extreme policies. Most companies fall somewhere in between. Okay, now what do you think, just roughly speaking, what do you think causes a company to decide not to pay dividends? All right, so how can that be justified? So can you, Iqbal, build on that? He's on the right track, but I need some. But if I am an investor, so I have put my money in XYZ company stock, how will the company justify to me, an investor, that all the earnings, rather than being given back to me, are being reinvested? Okay, you're right. Mahin, you want to build on that? The comment he made is correct, but I might as well ask her, just in simple English. Okay, one second. Okay, here is the question. Very simple question. Okay, one second. You are the CFO of your company, and you have decided that all the earnings are being retained in the company and not being paid out to shareholder. I am a shareholder at the shareholder meeting, and I asked for a justification of this policy. Okay, so that's on the right track. Now I'll just. So does somebody want to add just one important piece? Capital gains, but look, okay, so yeah, you are on the right track now, but the crisp final point is this. If a company believes that the return on the internal projects is greater than the required return on that stock, so if a company has a given level of risk and the required return on that company is, let's say, 14%, the company can reinvest money on projects that give a return of 20%. Does it not then make sense for the company to retain the money and do projects that are giving a high return? For example, take a company like 4G Fertilizer. 4G Fertilizer does not believe that it can take its earnings and reinvest on profitable projects because they have the market that they want to have. There aren't any more hugely profitable projects to do. So what does 4G Fertilizer do with its earnings? It primarily gives out as dividends. What about a company like Engro? Engro believes that the earnings that it has, it can reinvest in the company in other very profitable projects, and hence it reinvests in those profitable projects. Why am I as a shareholder fine with that? Because if the company is investing in profitable projects and then growing fast, what does that do to share price? It will increase the share price, so I'm fine with that. So that would be the justification. So most of you are on the right track. It's just the finish that was needed. Okay, now dividend policy. We've talked about it. Let's just go through what is written on the slide. The decision to pay out earnings versus retaining them, that is our dividend policy. Now, what are the sub-elements of a dividend policy? should we have a high dividend or a low dividend payout? Okay, that needs to be decided. Should the dividend be stable or irregular? Taha, what do you think this means? What does this statement mean? A decision of whether to have stable or irregular dividends. A stable dividend means a stable payout ratio or a stable amount in rupee terms. So if a company has a payout ratio of 50%, will shareholders get a stable dividend? Okay, if a company says we have a payout ratio, stable payout ratio of 50%, okay, Duriya, is that a stable policy or a non-stable dividend policy? Why? So will shareholders get a stable dividend? Then why are you calling it stable? Yeah, it would not be a stable dividend policy because earnings fluctuate, and if you are always giving out 50% as dividend, the dividends will fluctuate. So when companies talk about a stable policy, stable dividend policy, they are talking about maintaining a stable dividend no matter what happens to earnings. No, the amount, the dollar amount or rupee amount of the dividend should be stable to be able to call the dividend a stable dividend. The point is that a stable dividend by definition means that a company is trying to maintain a stable dividend. So the question is, what's the difference between this and interest? The difference, fundamental difference is, interest is an obligation. So when a company borrows money, it is legally and morally obligated to make the interest payments. With a dividend, the dividend, it can be, I can set an expectation that I am paying a dividend, but I am not morally and legally obliged to make dividend payments. So if I commit or say that I will make a dividend payment and then I don't, my stock will get hammered and I might get fired, but I will not be doing anything illegal by not paying a dividend. So that's a fundamental difference. The next point, do you think a dividend policy also includes a definition of how often my company pays dividends? Okay, do you know, so for example, 4G Fertilizer pays a dividend every quarter. Hubco pays a dividend every 6 months. There are other companies that might pay a dividend annually. Okay, so clearly the dividend policy also needs to define how often dividends are paid. Yeah. So obviously you look at the situation of your company and use that situation to define dividend policy. Okay, now, do you think investors in general prefer high dividends or low dividends? Okay, so I am hearing high, low, and depends. What are the three possible answers to this question where one of the answers is not depends? Exactly. So the three possible answers are high dividends, another possibility is low dividend, and another possibility is it does not, so investors don't care. Okay, now there are three theories in finance related to dividends, and those three theories say three different things. So everything that could be said is said in a different theory. Okay, the first theory is dividend irrelevance, which implies that investors don't really care what the dividend payout is. Take a wild guess who came up with this theory. Yeah, Modigliani and Miller came up with a theory that dividend payout ratio does not matter. Investors don't care what the dividend payout is. They are happy with high dividends, they are happy with low dividends. We'll see why shortly. The next theory is bird in hand. This, what do you think this theory says? So the investor prefers a high payout. Investor prefers a high payout. Okay. So, and the third theory is the tax preference theory. The third is the tax preference theory, according to which investors prefer a low payout. Now, let's get into the details of each. First, dividend irrelevance theory. I'll read this and then explain. Investors are indifferent between dividends and retention generated capital gains. Investors can create their own dividend policy. Okay, so according to Modigliani and Miller, let's say that you buy shares in a company such as Microsoft that doesn't pay much dividend. How can you, and then let's say you need cash, you need a dividend, how can you generate a dividend? You can sell some shares. If you have 1,000 shares, you can sell 100 and generate a dividend. That, according to Modigliani and Miller, is called a homemade dividend. What if you own shares in a company such as Forgy Fertilizer that pays all its earnings out as dividend, and then you really don't want a dividend? Yeah, you can do something called a dividend reinvestment plan, where you tell the company that, look, all the dividend, instead of sending to me, you just buy shares. So effectively then you have converted a dividend paying stock into a non-dividend paying stock. So given these arguments, Modigliani and Miller said that investors don't care whether a company pays dividends or not, and hence dividend payout policy is irrelevant. Okay, so the implication is any payout is okay. Bird in hand theory: investors think dividends are less risky than potential future capital gains, hence they like dividends. So investors like the fact that they are getting the money now. When investors don't get dividend now, it is a promise from the company that we are reinvesting that money so that you get more later. Okay, so that is slightly more risky. So investors prefer money now according to this theory. Yeah, so one idea being investors believe that money with them is better than money with the company management. So according to this theory, what policy would maximize the share price? High payout ratio would maximize share price. So if we live in a world where this policy seems to hold sway, then how can companies maximize their value? By paying as much dividend as possible. Okay, so investors would value high payout firms more than less payout firms. So companies, all else equal, that make higher payouts will have higher stock price. Higher stock price means higher value of the firm. So what's the implication of this policy, of this theory? That companies should have a high payout ratio. Now the third theory is tax preference theory, and before I get into this, let me just set some context. In most countries, the tax on dividends is greater than the tax on capital gains. Okay, so if you live in a country where this is true, tax on dividends, like even any of you who own stocks or know people who own stocks, when the dividend check comes in, the tax on the dividend is cut at source. In all countries, you have tax on dividends. Tax on capital gains in many countries is either lower, or in some countries there are no taxes on capital gains. If that is the case, what do you think investors would prefer? Okay, so next, what do you think? Yeah, they would prefer capital gains, because if the taxes on capital gains are lower, then investors would prefer capital gains over dividends. Now, just take one more point here, and then I'll give you the further information. Do you also recognize that tax on dividend is non-discretionary, in the sense that when you get your dividend, you have to pay tax? Whereas, is tax on capital gain discretionary or not? So next to Temur is Sadia. Is tax on capital gain discretionary? Is the timing discretionary? How? Exactly. You only pay capital gains when you sell a stock and realize the capital gain. So can you choose when to sell? Exactly. So in a sense, the timing on your capital gain tax is discretionary. You think that's a good thing for investors? That's good. So given all these factors, is it not clear that capital gains is better? So if that is the case, then if this holds true, then how can a company, then what do investors prefer? They prefer a lower payout ratio. Okay. So how can a company maximize value? By having a lower payout ratio. So lower payout ratio would mean higher stock price. Why? Because if investors prefer something, so they prefer stocks with low payout ratios, then they will pay more for stocks with low payout ratios. So what's the implication of this theory? That you should have a low payout. Okay. Now, what questions would be floating in your mind right now? So we have three theories, all three say three different things. So what is correct? What do you think? How can, actually that can't be the right answer. Yeah, it depends on what?
On the tax.
Okay, so just hold that thought and I'll come back to it. A few more basic points. So this is just a graphical depiction of what we've talked about. The possible price impact of the different theories. What's the x-axis here? Payout. So from 0 payout to 100% payout. What's the y-axis? Stock price. Do you notice why this irrelevance theory is a flat line? Why? Yeah, so investors don't care 0%. If the payout is 0%, they can create their homemade dividends. If the payout is 100%, they can use DRIPs. You know what DRIPs are? Dividend reinvestment plans. Okay, generally called DRIPs. You take your DRIPs or dividend and use that to buy back stocks. Okay, what about why does the stock price go up with higher payout ratio given this theory? Yeah, investors prefer high payout. So according to this theory, stock price will be higher if payout ratio is higher. And according to the tax preference theory, the stock price will be lower. Okay. Now, try to stare at this next slide for a minute, which talks about cost of equity, and see if this makes sense. Can you explain this? Okay, let's talk about this theory. So very good. So all we are saying is, let's take tax preference. Do investors like high payouts? No. They don't. So that means that the cost of, from a company perspective, if I am selling you something you don't like, I have to give you a higher return. The return that I as a company give investors is my cost. So when I'm stuffing something onto you that you don't like, okay, the cost will be higher because then I have to give you a higher return. So that's tax preference. Bird in hand is the opposite. If I'm giving you something you like, which is high dividends, then obviously I can get by with a lower cost. Okay, speak loudly so everybody can hear. Actually, cost, one second, is cost of dividend sort of represents cost of equity, but simplistically, actually overall cost. So for a company that doesn't pay any dividends, is there no cost of equity? That's not true. So cost of equity simplistically is tied to the riskiness of a company, something that we talked right at the beginning of this course, which was even if you have retained earnings, how do you come up with cost of equity? It's based on CAPM. Okay, if you are confused about that, go back and listen to the earlier lectures. Now, which theory is correct? Empirical testing has not been able to determine which theory, if any, is correct. Thus, managers use judgment. Now, let me give you an example. If you are operating in a country in the Middle East with no taxes, and you don't have the smartest managers in the world, okay, so which theory do you think would work best there? Bird in hand. You move to another country where capital gains taxes are zero and dividend taxes are very high. They're the tax preference. So you have to look at the context, the environment, and then figure out what theory applies in that environment. There isn't one theory that works everywhere. When you can't decide, then you go with M&M. Again, in Pakistan, I would again you can look at the context. My thought is I would prefer bird in hand. Okay. So now next important point. Do you know, so information content or signaling hypothesis, how does this apply here? First, a general point. When a company is paying dividends, a company, generally the management of a company that is paying dividends hates to cut dividends. Have you noticed that companies like Fauji Fertilizer that pay dividends, then don't just cut dividends? Okay. Now, let's say that to the right of on my right are people, smart people who run companies. So you are managers. On the left we have investors. Okay, so the managers do not like to cut dividends, which means that, let's say you announce an increase in dividends. Would you announce an increase only if you believe that higher dividend payout is sustainable, or would you announce it maybe just because you have a one-off good quarter? Yeah, you would only announce an increase in dividend if the higher payout is sustainable. Okay, the people on the left, your colleagues who decided to go into the investment world, they know that managers would only increase dividend if the higher dividend is sustainable. Does that make sense? Yes. So would the investors take the higher dividend as a positive signal? They would take it as a positive signal. So that is why you often see share price go up when there is a dividend increase. Now let me just illustrate 1 or 2 points and then I'll take questions. Okay, I want to tie this with some basic theory that you've learned. Let's take this very simple formula which assumes a given discount rate and sustainable growth. If there is an announced increase in dividend that is credible, what happens to the share price? Why? Because of this formula? Because what happens to the dividend? The dividend goes up. So dividend goes up. Can you quickly jump to the conclusion that price will go up, or is there more going on? Okay, anyway. So one second, this is exciting. Okay, let's listen to this. Okay, so dividend goes up. How many people will jump to the conclusion that because dividend is up, price is up? You will jump to the conclusion. Now, when dividend is up, remember what is G equal to? Retention ratio multiplied by ROE. When dividend goes up, what happens to retention ratio? Retention ratio goes down. If retention ratio goes down, what happens to G? What happens to the denominator? So what happens to the stock price? Goes down. So 1 second, the point here is that when a company increases dividends, the impact on the stock is not clear, because on the one hand your numerator is going up, on the other hand your denominator is also going up. Okay, so the numerator going up has a upward impact, the denominator going up has a downward impact. So in of itself, the increase in dividend based on this basic formula does not impact, or the impact is unclear. Now, empirically we notice that in general when companies increase dividend, share price goes up. And the point I'm making here is that increase in price isn't simply because of this mechanical formula. That increase in price is typically because of the positive signal being sent by the company. So the positive signal here is that we will have higher sustainable earnings in the future, which is why we are increasing dividends. And almost everything in finance is based on expectations about the future. So the bottom line statement out of this is that when you see price go up in response to an increased dividend, it is primarily because of the positive signal that a company management sends out by increasing dividends. Okay, so that is it for today's class.